the dispersion or the difference between where the price of gold and silver are right now and where it would be if the regulators would enforce the regulations and that would allow price discovery to come into the market. I mean, you can't have real price discovery when you've got, hundreds of times more paper gold and silver on the market than you do physical that can be delivered into those paper obligations. But just to kind of circle back in terms of the impression that I took away from the conference is that, I mean, as you guys know, well, I started in the sector 20 years ago, and for the first 10 or 12 years, people who were getting involved in the precious metals sector, they would love chasing the market when it was going higher, and then they'd get scared when the price would get hit, and they'd either sell their mining stocks, or a lot of people would even resell their gold and silver coins. So and the impression that I've been taking away over the last few years is that it's first of all, it's a wider audience now that is participating in investing in the entire sector, but also that and you hear this from the coin dealers. Specifically, I heard it this past week from Andy Sheckman, but I've heard it from several, that whenever the market gets smashed like it does today, retail comes in and they buy more gold or silver, primarily silver. So and that's what I think. I don't think retail in and of itself can break the market, but it's as marginal buyers, they can certainly help push the price higher.
Yeah, and I suppose on the other side of things, I mean, you as a physical holder, whether it's gold or silver, it's the same thing. Are you forced to hedge those positions, Dave, along with everyone else? And obviously this gaming, there comes a point where you may have to hedge stuff and become part of this paper game.
I mean, I guess I'm probably guilty of being a permabull for the sector, and that's just because to me there's just an enormous arbitrage opportunity between what I think the intrinsic value for gold and silver is, which is much higher, versus where it trades, and is obviously the price setting mechanism is the derivatives market and the unallocated gold system on the LBMA. I mean, from time to time, we've tried putting on hedges, and it's tough. It's really just a function of if I get bearish on the market, or I think we're going to go through a correction, or a correction cycle, or a pullback, I'll try to raise cash by selling the mining stocks. But in terms of the physical gold and silver that we hold in a non-COMEX vault, we don't touch that, and we don't try to hedge it. And I mean, my biggest fear is if let's just say we tried to sell some of that, or we wanted to sell some of that gold and silver, I'd be worried about maybe being able to replace it down the road at some point.
Very, very good answer. I mean, Dave, that makes total sense. That is exactly how I think I see things as well. I mean, that we're not in the paper. When you talk about physical here, you're talking about physical gold. I don't know of a single client in all the years that has ever sold. I mean, we're talking about wholesale side of things. We're talking about clients with a lot of bullion, gold and silver bullion. And yeah, okay, maybe some coin guys do. And I don't get involved with the coins. So maybe you do see some of the coin guys flip in and out. But I don't see a single ounce ever come up for sale. So it, much like you, I think I view it as an opportunity, because at least we're gifted with the view of the wholesale market, the real footprints, as opposed to this absolute hocus pocus of paper supply, which obviously we have to keep an eye on. But we look at it, I think we look at it in the same way. Hey, maybe this is the best opportunity. And where the hell, if I did sell it, would I replace it is a very good point. At what point will we see a revaluation? There's so many things to consider.
One of the things that I found interesting was Andy Sheckman of Miles Franklin, and they've been around for a long time. You guys know them, and he was talking about, we're talking about, signs that we'll see when we think the market's getting, when they're finally going to be able to break the derivatives market. And, one of the signs is you're going to see premiums on the coins and even the bars widen out quite a bit, before there's some type of default on one of the major exchanges. And he said that, silver, the premiums are really wide right now. Well, imagine if you're trying to, game the market and you expected a sell off in the price of silver. And so you sell your silver in the high 20s and now it's in the, 23, 24 range. And you say, oh, maybe I better replace it. And, all of a sudden you're paying what you received when you sold it because the premiums have widened out. And that's a sign of scarcity, at least at the retail sector. And he said, we're not seeing premiums like that in gold yet. He said the dealers have plenty of gold. And so I said to him, I said, well, I don't, silver is what it is. I want to be the first phone call when a big hedge fund calls you up and says, sell me all the gold that you have, or as much gold as you can. And he said, well, I actually just got that phone call a few days ago, and it was a big investment management fund. I don't know if it was a hedge fund per se, and they gave him they said they're looking to buy, and I don't want to put the exact figure out there, but it had 8 zeros after it, worth of gold bullion coins. They didn't want bars for some reason. I'm not sure why. And when I thought about it afterwards, my guess is if it is a hedge fund, they're probably looking and saying, you're probably going to game the premium to some extent, because I mean, I said when I, kind of got up the curve and sort of at least thought I figured out what part of what was going on, and this was 15, 17 years ago. I said at some point we're going to see 100% premiums on gold, at least on the retail side on gold, because there's just going to be such a scarcity and there's going to be so much money that has been printed looking to buy physical gold and silver.
It makes total sense, and so as you say, it's this whole, there's this disconnect. We're talking about this disconnect between the paper and the physical price, and then the resulting, and you're talking about that there's going to be indicators like premium expansions, etc. But it was really interesting yesterday, and this is something I is so fresh in my mind because it's not out there yet. So obviously, we're very involved in the wholesale market, and yesterday, and this is a bank yesterday, and this is the interesting part, just as silver pit opens, and what does silver do? Bang, down it goes. Today again, pit open, bang, down it goes. Just as it was going down yesterday, we were chasing some silver, and we got a phone call back to say, sorry, by the way, Standard Chartered, one of the market makers on the COMEX, has just come in and taken every single ounce, future, not just now, but they've bought every single ounce out of this is one big supply, and I won't name them right now, but it's a very big producer, and they've said they've bought everything, including forward production into 2022. Now, come on, this is while we see this tanking price, we see Standard Chartered, a COMEX market maker, out there buying spot gold, locking in the price in the spot gold market to buy everything in the future. Now, spoke to Argor and they said, and this is starting to feed back, spoke to Argor yesterday and they said, we're going to have no silver. We're going to have no silver next year. It's like, this is crazy. And this is crazy. And so when we look at this market and you see this price, but to me, I think I know what the game is. And I think we know what the game is that when we look at these short sells coming through on the COMEX, boom, 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 bang, 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 bang. And it obviously it forces out moving averages. You can trip out, where the long stops are, all the game. You also know, then what you're going to do is also incentivize hedging, legitimate hedging, people going short to hedge positions. big funds out there having to do that. And then suddenly, but when we look at it, we go, hold on a minute, because the over-the-counter market is so opaque, and because it's still, I mean, silver, we reckon 500 to 1. Gold has been 100 to 1. Even Reserve Bank of India says gold 100 to 1, 92 to 1, they said.
Yeah, I remember that.
But 500 to 1 silver. So what we're seeing is, to me, is we're seeing unrealized, these guys are out in the spot market. Now, I can go out in the spot market right now, as you can, and on the over-the-counter market in the UK or anywhere in Europe, and I can buy a lot of spot silver. It's a paper position. Nobody realizes whether that's going to be crystallized into physical or not. So these guys are out there buying all this physical, locking in the price. It's just a number until it actually is crystallized. It's not transacted. So it just sits there. In the meantime, they're hedging that position on the COMEX, and you see all the shorts appearing. And so the COMEX-centric guys in the casino see all these shorts coming in, but don't see the long side of that transaction. And this, to me, is exactly what's going on. And this tells me what a screaming opportunity this is right now.